Well, hello and welcome to Trading Blows. Another busy show ahead. Plenty for myself and the panel to get our teeth into. This week, we're going to discuss the recent breakdown in the dollar and whether that bearish momentum can continue. We'll also have a look at the recent inflation data in both the US and the UK, what to make of that and what the policy implications there may be. And we'll also dig into the equity market as well. We've had a strong start to corporate earnings season and some decent upside momentum in stocks as well. So we'll see whether or not that can continue into the rest of the summer. Without further ado, let's get into the show. So, as I said, plenty to get our teeth into this week. Without further ado, let's bring in the panel. Joining me this week, veteran of the City of London, and he's now lost his comedy glasses, Mr. Richard Matthews. Ryan Paisey, who still hasn't had a haircut and is also still the founder of PIQ Suite. And last but by no means least, from some sort of basement by the looks of it in the City of London, Adam Linton, the head of the European desk over at Newsquawk. With that said and done, the panel on the show, and Adam having his cup of tea, let's get into the first round. So, Ryan, we'll kick off the show with you this week. We've had a big move lower in the dollar over the last 5 days or so. The dollar index trading below 100, breaking out to the bottom of its year-to-date range. The euro pushing higher, cable pushing above 130. It's nice to see a little bit of volatility come back into the FX market. Do you reckon this can continue? And do you reckon the dollar's got more room to run to the downside and this momentum can persist?
Well, firstly, thank you for having me. Thank you, everyone. Nice to see you. Also, a big shout out to my friend, the Carney. But yeah, it's fine.
Not Carney, is it?
No, definitely not. This one's a good one. But yeah, in terms of vol, I think there will be no boring summer markets for FX traders. The veteran FX traders will hate that because they love a summer off. Obviously the punters will love that because it means there should be some action. I think everyone is talking about US dollar now. It's broken below its downside. Broken to the downside on its year-to-date range, flirting with that psychological 100 level in the Dixie. I presume that Pepperstone have a USDX contract or DXYX or something like that.
We do. And actually, I've done my homework from last week.
Funny enough, that's one of my questions I was going to ask you. So what is the cable index?
There isn't one.
Oh,
I know. After all of that.
Right. Okay. So big wigs at Pepperstone, please fix that. The big story is obviously the dollar. Obviously CPI last week. Yeah, my dates are all over the shop. Obviously came in softer than expected. Which is great. We all knew it was coming. Base effects and stuff were starting to wear off. Although, as we mentioned on a previous show, that come I believe it's September, they kind of start adding to the base effects, start adding to the proceedings. So that'd be something to watch. To be honest, I know everyone talks about the dollar. I really don't trade FX. I couldn't pick my nose in that market, let alone a winner. One thing in terms of overall looking over what's going on in the landscape, I think it's quite interesting that Euro's winning streak and the rate hike expectations is Euro's on its longest winning streak since 2004, but it's winning on bad news. And I think it's very important to stress that it's, core inflation in euro area is picking up a little bit. Again, we had some figures out this morning showing that beat expectations, which, ironically, on the same day that UK inflation data came in below expectations. So, the talking heads have gone from saying, it's all UK bad, Eurozone good, to flipping around again. It's tunes change quite quickly. Personally, I think if you're looking at buying into the euro ramp now, you're delusional. Although it's going up on bad news, I've got a feeling that the fact that it is in trouble will start coming to the fore. If we're kind of zooming out, obviously we all know that I like more of a geopolitical news kind of flow than anything else. I'd have an eye on the wildfires and whatnot that are going on in Europe. In terms of I know it's around Greece and Rome and that, and to kind of bit highbrow here for you. It's the EC, the wildfires in Greece and Rome. Italy are the ECB's Achilles heel. Same region. See what I did there? Which obviously could
notes have you stolen this week?
Well, I told you it's ChatGPT. It could exacerbate the sticky rising inflation story. I did think kind of something that's quite interesting to notice on particularly Eurozone inflation, and also all inflation now, because we're in that kind of period where some elements are kind of it's not just like all inflation is coming off, all inflation is going up, right? We're in that kind of that balancing act place, what you want to call it. So, for instance, core inflation, if you and strip, so not just core inflation, but so obviously core and headline, but also stripping out the actual meaningful factors within inflation. I know we're going to go on to inflation in another sector, so in another section of the show, so I won't go into it too much. But just when you're looking at what the ECB or what the Fed or what the BOE are looking to do based on inflation data, if that's all, one, you shouldn't only be looking at that one data set, but if you were, be mindful that there is good inflation and there's bad inflation, so to speak. I know, you know what I mean. In terms of that, can I talk about cable? Am I allowed to talk about cable?
Oh, God, save your cable take until we get onto the UK.
Okay, well, I know I did talk about euro more than the dollar, but I think basically the dollar now, for me personally, I think it breaks lower. Why? Because why not?
We can let you off because, as we all know, the dollar index is 60% weighted or whatever it is, or 58% towards the euro. So it is effectively euro dollar just turned upside down. Right at the start of your answer, you mentioned veteran FX traders, and thankfully we've got one with us today. So Dick Matthews, what's your take on all things that are going on at the moment?
That's a very good question. Very good afternoon to you all. Nice to see Ryan's dressed for the occasion as always. First of all, I'd like to take issue with Ryan a little bit about these dreadful heat occurrences in southern Europe. I lived in Spain for 20 years, and every year we would have at least a week, if not 2 weeks, of 45 degrees plus. I don't think it's anything out of the usual. I think the BBC getting hysterical as a complete non-event. However, I think there are still inflationary trends in Europe. Olive oil, believe it or not, is up 27% this year, and the cost of a margarita is going through the roof. And I think that the problems in Ukraine are still going to carry on. I think we've got this issue of getting grain out of Ukraine now. Is it 4 million metric tons they've got to move?
Tons.
So, fundamentally, I think Europe's still got some problems. I think looking at currencies, it's almost an interest rate play, which goes back to an inflation rate play. I think the States actually is going to do okay. I quite like the dollar. I think it's got oversold. I think the economy in the States looks pretty good. I think they're going to carry on quite strongly.
Sorry, Dickie, just to butt in there. Sorry, but you say so you're bullish the dollar because you think the economy's looking pretty good, right?
Yeah.
But aren't we suggesting that if the economy's looking okay, then it seems, from the data we've seen, it seems to be like the data's been coming in good, which is why the dollar's been getting sold off. Are you suggesting that maybe that's kind of the wrong narrative, and then we're going to look to flip back round, or? And I think good data is good for the dollar is what I'm trying to get at, because obviously we've kind of flipped recently.
What I'm suggesting is that the economy is stronger than people think, and that they are more likely to carry on hiking rates than people expect. So I think you'll see that the balance of interest rates differentials will change in the favour of the States. There are some odd figures coming out, or rogue figures, and it's a really hard economy to read, as they all are. And I've said, I think every show I've been on here, it's really hard to look at these figures because we've never seen anything like this before. We've never had a pandemic followed by a war. And so actually looking at 1 month's figures in isolation is a nonsense. And probably even looking at 3 or 4 months together is really, really difficult. I think that the States is going to recover. Inflation is going to bounce back all over the world. I think you're going to see it smooth a bit and then bounce back higher. The only thing which I find really, really interesting, or the major thing I find interesting, is that money supply is still slowing, which should lead to disinflation, but it's not. And that's really strange. And there's something odd going on with the money supply. But overall, I think the sell-off of the dollar has been overdone. Fundamentally, the euro and sterling are still pieces of poo as far as I'm concerned, and sterling probably a little bit worse than the euro.
Well, we'll get on to sterling in a second, and hopefully the inflation numbers that we had out this morning have just calmed you down a little bit, Dick.
They have. I'm very relaxed.
I was going to get some popcorn on as well. I completely forgot when we started talking about the UK.
Cool. So, Dick, I mean, I'm certainly with you on that one. I think the move's got a little bit too far. Adam, what are your thoughts? The Bears had their fun last week, below 100, a little bit of consolidation to start this week. Where do you see the risks tilting over the near term for the greenback?
I think I'm on the same page as Dick. I think, if you look at this kind of dollar move, we look at this dollar move that we saw since last week, it was purely solely on the basis of that inflation report we saw from the US. And, that kind of saw a bit of a reprisal of the view we saw in the aftermath of the June FOMC, where the main takeaway from that was they're looking for 2 more rate hikes this year. And then I know we'll touch on the Fed in a bit, but now it's looking like July is almost nailed on and there's less chance of that second hike forthcoming. So that's pretty much why we've kind of lost 100 status. But then, as you're right to point out, FX is all relative, and the components of that dollar index are mainly the euro, sterling, and the Japanese yen. I think when you look at euro, it's been kind of benefiting from a minor positive interest differential rate flow, but I'm not too sure how much of an impulse that's going to have given going forwards. I think we're probably priced as hawkishly as we can be. And then, we saw those comments from ECB's not yesterday, which I think were quite interesting. He's very much one of the more hawkish members on the governing council, and he wasn't really willing to, put September firmly on the table. So
he was. We could say he was not willing.
Yeah, exactly. Yeah, he said it was a possibility, but not a certainty, and that's normally the God, so I just got that. Yeah.
You really took your time there.
Dude, that food coma is really kicking in.
But yeah, I think, normally the Hawk's incredibly vocal. So the fact that he isn't willing to put his name on it, I think it suggests there's a little bit of trepidation now entering into the ECB. And I think there's going to be a slightly more even-handed debate around their meetings than there has been. But also, if you look at modelling, ING said that euro dollar, by their reckoning, is about 3% overvalued as well. So I think that interest differential rate story could easily turn around. It's looking a bit overvalued. And then if you look at the pounds, which we'll touch on, at the start of the week, there's about 115 basis points worth of tightening priced in. That's obviously unwound somewhat. It's going to be hard for it to get any more hawkish from here. But again, we'll touch on that in a bit. And then if you look at other driving forces, such as the Japanese yen, I think I've been relatively consistent. I don't really buy into the BOJ tightening story. I know some people in some quarters have been getting a little bit carried away that, they may tweak yield curve control to let the 10-year yields fluctuate a little bit more, or they may target the 5-year one. But even if they do that, and it doesn't look like they're even going to do that now, given the comments that we saw from UADA yesterday, who really cares? They've still got to then scrap yield curve control. They've then got to wait to then start hiking rates. And by that point, the rest of the world's done 400 or 500 basis points amongst themselves. So I think when you look at sterling, euro and yen, it's hard to get that bullish about them. And if that's the case, then, you could suggest that the bottom could be in for the dollar index. I also agree with Dick that, growth is holding up better in the US. So I don't think things are going to get more dovish than they are currently. And I'm not too sure how much of a steer we're going to get from Powell next week, but I think this move's kind of run its course for now.
We'll get on to Powell in a second. Go on,
Ryan. In case anyone was wondering what the UADA comments were yesterday that Adam referred to, basically said that we're still some distance from sustainably achieving the central bank's 2% target. So signalling resolve to maintain the ultra-loose monetary policy. Just a bit of added value there for my good friend Adam.
There we go. Speaking of
what he said yesterday after today's figures in Europe.
No, this was UADA. Japan, mate. Japan.
I'm talking about not.
I'm not.
Oh, God. Speaking of UADA, I was just going to say, did anyone see that Arno Venter, good friend of the show, found a petition. Someone started a petition to have UADA removed as Bank of Japan governor because he's managed to weaken the yen. during his tenure, which is
never last.
I was going to say, but perhaps the best excuse I've ever seen for someone being underwater on a trade. Anyway, let's get on to Chair Powell and to the Fed and to US inflation in the next round. Right, Adam, we may as well start with you because I feel like you were going to naturally flow into this anyway. Obviously, we had that cooler than expected inflation data out of the US last week. Can we just stop worrying about inflation now? You know, headlines at 3%, cause at an 18-month low. The market is all happy and getting all excitable again. Or do we think the Fed is still going to remain as hawkish as they have been? Obviously, we hear from Fed Chair Powell, this time next week, of course.
I mean, I wouldn't say stop worrying about inflation. I think that would be pretty reckless given
Live a little, mate. Live a little.
Everything we've been put through over the last 18 months to 2 years. When it comes to kind of forecasting inflation, look, it's beyond probably the scope of this podcast. I mean, central banks can't really do it themselves. Forecasting on a month-to-month basis is difficult. So at a quarter and quarter one, it's obviously incredibly difficult. My best guess would be that we're not going to see an acceleration in inflation, but I think the journey back to target is going to be a long, slow one, and is one that will probably play out over the next, say, year, 2 years, possibly. I think we're possibly in a slightly different, economic environment to we were pre-COVID. If we do enter into this phase of deglobalization, then things could take quite a while to, kind of return back to quote unquote normal. I think if you did kind of want a framework for how to look inflation, I think specifically in the US, I think you need to look at basically what growth is doing. And, the signals from there have been relatively unambiguous. We've seen Goldman Sachs, they cut their odds of a recession next 12 months to around, I think it's about 20%. And then we saw the Bank of America Fund Survey. It says projections are now significantly more in favor of a soft landing than a hard landing. So, to me, it kind of suggests that if this is, growth is holding up, allied with the fact that the jobs market's still relatively strong, then inflation would be stickier than you otherwise would think it would be. In terms of kind of how I think this kind of translates into kind of the Feds, look, I think July, that's a done deal. I don't think we really need to dwell on that too much. I think my bias now is actually, I think there's a world in which a hike in November is potentially more likely than September. I have the feeling that the FMC will kind of have a slight bias to kind of pause after July. And because I think inflation will be not necessarily too unfavorable towards the Fed. I think they'll kind of want to see how things have gone so far and see if there is a bit of a turn in the data, see if things are, needing to see an extra hike. And I think they'll probably wait until November rather than September to do that. And if they do that, then, some of the 2024 rate cut bets could be kicked into the grass. But I personally think the 2024 rate cut bets, I think it's just kind of a little bit pointless almost thinking about those. They just change so much on a week to week basis. So they're looking like a month, a quarter away. It's just like you have absolutely no idea how that's going to play out.
Yeah, the other thing with those longer run rate cut expectations, particularly into 2024, is that actually, by and large, they're just a reflection of the range of possibilities that could happen from, absolute economic Armageddon through to things are all kind of okay and they don't cut at all. So, yeah, I would certainly agree with you on that one.
They're also, as well, like reading them, some people get confused as well, because that's kind of like the basis point changes from where we currently are. Yes. So therefore, if one thing people always fall into this trap is if we do get two more hikes, then you need to impose that maths onto the equation, and therefore to get to the same level, you need more rate cuts. People always kind of fall for that kind of trick, saying, "Oh, they've taken out once the Fed have hiked, they've taken out a rate cut bet." It's like, well, no, we're just at a higher level than we were pre-release, if that makes sense.
Right. Well, I think there could be a little bit of disagreement here with the rest of the panel, because I know Dick and Ryan have quite diverging views on the state of inflation and Fed policy. So age before beauty, we'll go with you first, Mr. Matthews. Are you still of the view that we're going to get a 6% Fed funds rate and another peak in inflation?
Yes.
Next question.
Can we have a little bit more?
Yes, I think show you working.
Yes, I am. And I also think that rates are going to stay much higher. Are going to stay high for much longer than anyone thinks. As you know, I've expressed this view before. And when people start praying for rate cuts, I think a lot of people, and you youngsters are probably amongst them, have never seen interest rates up at these levels before, and are expecting them to go back down towards zero. They ain't going back towards zero. I think the lowest you'll see going forward is probably 4.5%. I also want to just come back, having shot my good friend Ryan down on his views on the weather in Europe and how hot it is in Europe.
But all of a sudden, all the corn in America is going to suffer because of the heat. I know where this is going. I know where this is going.
Trades corn, would you?
The weather in America is absolutely extraordinary at the moment. And I had a very long talk with a very good friend who's an agricultural trader last night, and who's just shouting at me, don't look at treasuries, look at agriculturals. And buy December 26 corn. The further out you can buy it, just buy it, load it up. His argument is that you're going to get more and more of these bizarre weather events in America, a bit like train crashes in America. And they are really, really suffering this year. And agriculturals actually are quite strong. The other point he went on, and my biology is absolutely awful, but he's going on about photosynthesis.
We can see.
Thank you.
Is this the first time photosynthesis has been mentioned on Trading Blows?
Ryan's actually going to go and have to look that up now, I think.
I'm going to ask Ryan to spell it.
I can't spell corn.
Yeah, but you look it up enough. The fires in Canada are going to affect photosynthesis of the crops, so they could have a really tough crop season coming through. So I actually think that inflation is going to bounce back up, and Chairman Powell's going to come out hawkishly as he can next week. He's going to do a rise, and I actually agree with Adam. And I think you'll get another rise at back end of the year, November. I wouldn't bet against. However, whatever Powell says, I think the market's just going to ignore him. I just think they've got their happy hats on, and they're just going to keep buying things. When the autumn comes, the market may well turn, but I think they just want to shrug off, and everything's rosy and everything's great. We're going to have a soft landing, which you're not, because you're not going to beat inflation unless you have a real train crash.
We are beating inflation.
So I think it's going to be an interesting summer, lots of volatility, but I think the real volatility will hit in the autumn.
Right, now let's get the other side of that coin, Ryan Paisey.
Well, so this is it, right? So there's a few points I'm in agreement with Dickie on.
Photosynthesis?
No, mate, I'm not really going to even pretend. I'm not even going to go try and say the word, let alone spell it. So in terms of CPI and whatever CPI, inflation, I think, it's quite a historic moment. I think this is the 12th. I know this is the 12th consecutive month of cooling inflation. Round of applause.
You know what happened the last time that happened, Ryan?
Oh, go on, tell us. Second World War, First World War? I know.
Depression.
I know what the invention of fire. Go on, you tell me. You were there.
The first Great Depression came in the
States. They invented the wheel.
Mark my words, you'll see depression before you see inflation beaten.
So, even though I am, as we all know, I'm a massive believer that we've gone past peak inflation. It's all downhill from here. We will struggle a little bit, no doubt. As I said before on the previous round, the base effects are no longer our friend come September. However, saying that, I don't believe we're going to get runaway inflation again. I don't think it's going to be anything uncontrollable. I think we could, stick around the 3 to 4% inflation, maybe get a little, maybe get down to high twos. I think it's very important as well, and this is kind of just a bit of a sidebar. This 2% inflation target that everyone talks about was someone, as Dario Perkins, who's a very good follower on Twitter, has mentioned, it was someone giving a interview, and they just picked a random number about, central banks look for 2% inflation, and it was just basically a throwaway comment that got out of hand. There's no scientific, no economical kind of sciences or whatever proof, or even desire to have 2% as the desired inflation. It was, and I'm not making this up, it was a genuine throwaway comment on an interview that got well out of hand.
It was
this 2% target is bollocks. Okay, if the economy is doing well and and the stock and assets are going up and wages are going up and everything, as long as the velocity isn't killing you, we're all good. And I think it's important to remember that velocity can be more important than the overall number. Anyway, I digress. Regarding in terms of the type, again, going back to what I said before about the types of inflation. So our last US inflation report, I feel, everyone was kind of, whoop-de-doo, and including me, round of applause, it came in under expectations. However, the drop was because of airfares and used cars. That was a big deflationary drag, right? They're not everyday purchases. Positive contributions to the last CPI that we were all cheering that was below expectations, but the positive contributions to that number that were just outweighed by airfares and used cars were food and energy. They are everyday purchases. I think it's very important, again, like I said before, to know what is making up the inflation data. Also,
airfares can be boosted as well because it's July 4th holiday travel as well for the next month. So that all these things, they kind of flip and change all the time.
This is it, right? This is it. And if you get, not only are they not everyday purchases, but they're not everyday. They're very rare purchases for a very few people. What's the stat about the amount of Americans that don't have a passport, let alone travel domestically or whatever? I think if you look at, I'm always finding new things to look at. Don't. Easy. Stop it. It's a family show. But I think global.
Now.
Well, my mum might listen. It's the global inflation numbers are quite interesting as well. They're on the rise. Well, not on the rise, but they're still printing at 0.2% month on month, excluding China data, because you can't believe that. Don't get it wrong, it's the lowest reading in 2 years, but that'd be something I'd be looking at because, especially with agricultural commodities, as Dickie said, domestic production in certain areas could be under the cosh. So, you've got to import. So it is wise to look at what food prices and whatever we're doing elsewhere. I did see a stat during the week. I might be misremembering this, but I'm sure it was that Brazil are now exporting more soy than the US, which is apparently the first time it's happened in a long time. And so anyway, the ag traders were going all over it. So I thought that was quite interesting. What will the what will the Fed do? As my good friend Adam said, there's no point discussing the next meeting. It's going to be 25 basis point hike. I think that's it done. Again, I now think it's very important. I do believe so many people are forgetting this. You only cut rates when you need to, right? For some reason, it seems to be ingrained into people, especially the newer people, and it's no fault of their own because it's the only kind of markets they've known. But it almost feels like good news means you should cut rates. That's what what I'm saying is that's not what you should do. But that seems to be what the vibe is on social media and these newer analysts and whatever. Good news means you hike rates or at least sit on your hands. So it's only because of the situation we've had over the last few years or whatever, where everything's gone out of whack, that some people go, oh yeah, the economy's great, it's time to cut rates. That's not how it works. So yes, they're going to cut in July. Sorry. Yes, they're going to raise. They're going to hike in. Yes, they're going to hike in July. I believe that's it for the foreseeable. Mainly because I'm not going to start trying to guess when they're going to, or what they're going to do in November, because no one knows. Fed certainly don't know. I really hope that the Fed Powell sits on their hands for as long as possible. And, if in November, December, January, whatever, they decide to do something, then yeah, fine. But I wouldn't be making trades based on that. And again, it's going back to velocity is the killer. If they start hiking rates after sitting on if they hike rates 0.25% after sitting on their hands for 6 months, and they've really, really communicated and telegraphed that they are going to raise rates, asset prices won't suffer. They won't go off at a tick if it's been telegraphed and communicated correctly. Because if it's because the economy is growing, it's a good thing. Mm-hmm. And we will get back to that, hopefully, unless there's another crisis around the corner, we will get back to that situation where rates can tick up and tick down slowly, well communicated. asset prices keep trundling higher. Well, equities.
Well, let's hope we get back to that situation in the relatively near future. But in the here and now, we're going to get on to the third round. Right, more inflation chat. Apologies if you're not a fan of us talking about inflation, but, well, sort of tough luck this week, such is the vibe in the markets at the moment. Dick, we've got to start with you, really. I mean, you've probably been
Dick.
the most vocal man out there with regards to inflation and the Bank of England and everything spiraling out of control. So, I mean, you must be pretty pleased by this morning's data with both headline and core CPI. Yes, it's still high, but coming in below expectations at the very least.
Before Dick answers, can I just suggest that we do a minute's applause for Andrew Bailey and the fine work he's been doing in saving us from inflation. You know, today is the turning point. He's done it.
Yeah. He's done it. He's done never in doubt.
Yeah.
Has he
pound?
Did Sunak mention it during PMQs? Obviously, too busy trying to explain why Farage had his bank account taken away from Coots by Coots.
Oh, God.
Sunak will be trumpeting the great success that he's having, and we're heading into the...
Are you a fan of a weak pound?
Huh?
Are you a fan of a weak pound?
Oh, God. Can I be given a mute button for Ryan next week? I think we need an off switch for it. Yeah. Right, Dick, come on, take it away.
Need an off switch, not necessarily just for this show for Ryan. I mean, so we're out of the woods, aren't we? I mean, inflation's great, it's under control. It's only nearly 4 times the Bank of England's target level, which probably gives them a problem next week. I know Sonia curves now is 50-50 whether they do 25 or 50 basis points. I think that politically, it's almost a political call, actually. I think he's under such pressure that he may on the side of doing 50, which obviously would help sterling bounce back up. If he does, I think then that could well be 50, and that's it. And just wait and see how things pan out from there. Is inflation under control? I'm not convinced it is. I think that wages are still too high, pushing it higher. I just wonder, I've said this before, I just wonder when you're going to start getting a risk premium coming to sterling for the elections next year. You've got 3 by-elections tomorrow, which I think will be a resounding 3 resounding losses for the Conservatives. So all in all, I don't know, Bank of England's lost all credibility, not just the market members, but actually I think Joe Public has got just given up on the Bank of England knowing what they're doing. So I think they've got a battle there to get faith back in what they're doing. And to be honest with you, I think the only way to do it is get rid of Bailey. The economy, I don't know, seems to be
that's Adams. It's so unfair. So unfair. The big dog.
The big dog. Yeah.
You can stick up for him in a minute, but let's let the other big dog finish.
I know that you're a Bailey lover. There are some. I don't know. What's the opposite to the first swallows of spring? I don't know. There's some nasty stuff.
Big swallows.
Ryan, behave. There's some odd signs coming out. The housing slowdown's obviously affecting people like DFS, whose sofa sales are always on sale, but they're very, very low. We've seen the most company insolvency since 2009. So there are some worrying signs there. But I guess all in all, I don't know, it's just stagflation, isn't it? That's what do you do on stagflation? You tell me, you're the economist. I don't. I haven't got a really strong view on what you should be doing. As always, I don't like cable, but I think generally.
Oh, really? You're not mentioning
Well, that's the issue, isn't it? Inflation is coming down, but it's still 8%, and we still don't have any growth in the economy. So I guess, it just speaks of how abysmal the situation was when we're all sat there at 7:00 this morning going, oh, great, this is really good news. Well, yeah, it is, but let's have a bit of context around it. Adam,
the government's doing absolutely nothing, is it? There's no you get a monetary move by the Bank of England, but the government does nothing fiscally. And I'm no great lover of what Truss said, but I think you could argue that Truss actually had some vaguely sensible policies.
So just before you go to Adam, I just want a quiet private word with Adam. Adam, I don't know if you've noticed, but I think the way to get some points, mate, is just start slagging off central bankers and particularly the Bank of England. You're gonna get a load of points. So
I was going to say, did
a point taken off?
I was going to say, did Bailey once spill his drink on you in a nightclub or something?
Yeah.
Where does this come from?
I can't imagine. Well, I can't imagine myself in a nightclub, let alone Andrew Bailey in there with me. But
I thought it was all about Dickie.
This could go on a whole
I thought
different
it was about me and Andrew Bailey in a nightclub. Wow, the City of London nightclub.
Right, Adam, let's try and restore some semblance of order. What do we make of the inflation data earlier, and what does it mean for the BOE?
I mean, I think first of all is let's not just get too carried away with one report. We've had one, slightly more favourable report that comes off the back of a load of incredibly disappointing ones. I think for the Bank of England, I think we get 25 basis points in August, not the 50 that people had been expecting pre-release. I think, about 6 weeks ago, whether it was before the June meeting where they hiked 50, you could see how tentative some of the Bank of England officials were about further hikes. You saw like Bailey, you saw like Pill talking about, this monetary transmission lag. There's a lot of tightening left in the pipeline. So I think any excuse they can to step down to 25 from 50, I think they're pretty much going to take. Yeah, at the start of the week, we had tightening, what was about 115 basis points worth of tightening was priced in. That's pulled back to about 85, I think it was when I saw. I don't think we're ever going to get back up to 115 basis points priced in. That was always looked a little bit aggressive. So I think we're coming back to something more in the realms of normality. 85 implies we get 3 25s and there's about a 40% chance of another. I wouldn't be surprised if things, not necessarily is what they should do, but I wouldn't be surprised if inflation does continue to pull back, that we get 25 in August, 25 in September, and then they're potentially looking to try wrangle in a pause. Because if you look at services inflation, I think that's, one of the key takeaways from today. That printed at 7.2%, which was below the MPC's forecast of 7.4%. So I think that's definitely one to watch. Obviously, it's elevated, but then when you combine that with the fact that energy inflation is going to be acting as a very much headline drag going forward, it does very much kind of change the inflationary narrative that we've seen over the past few months. If people see things are moving in the right direction, then I think, the Bank of England will use any excuse they can to kind of latch onto that. But, as Dickie says, the labour market needs to kind of start playing ball. I think wage inflation is still the big concern. So that's definitely what people should be looking out for. The stickier that wages are and the potential follow through there is for inflation, that's when, you can get a little bit of concern. So yes, today was welcome, but let's, not get too carried away.
Oh, well, there we go. There's one to put a downer on the mood. Ryan, are you, this is a stupid question. Are you still bullish, Cable?
Well, first off, go Gadget Pound. Everyone, just have a round of applause for Prince of Pound. Sorry, don't say it. As I said last week, things have started to get complicated for Cable, mainly because when you're so far on side, you need to find yourself booking profits. You know what I mean, Dickie? Else you wouldn't. I said last week booking profits was probably the trade, assuming you listened to Uncle Ryan and you were along from a long time ago. I agree with everything that Adam said, and to an extent, Dickie, apart from the Bailey bashing, which, I'm a big fan of Bailey, to be honest. I think they get a bad rep. I think it's something to be aware of is we've now got the combination of very, very stretched position in Cable, obviously longs, and we're now getting some weaker than expected inflation data. If this trend persists, and it does seem that inflation is kind of going to come off as rapidly as it went up, then it could be look out below for sterling, purely because the combination of there's a lot of rate pricing that could be mispriced, as in far too hawkish, and there's a lot of weak longs in sterling. There's a lot of people that have come to this trade late, and if this starts turning, they'll be the first out the door, and it will be who can get out the door quicker. So that's something that I would be really concerned about. If you're long and you've been long for a while, I'd sit on them. Obviously, as I said last week, book some profits. I'd be hesitant to get in here or add here. That's an outright lie. I would hate to be getting in here or hate to be adding to here. I'm sorry, getting in or adding here. I'm not saying we definitely go lower, and I'm definitely not saying never buy it here. But if we can trade sideways for a bit and kind of build a bit of a range around here, then maybe look to push for the upside again. But I think it's one of those where that elastic band's gone a bit too quick, overly stretched. Before Wednesday's data, as we were talking, as Adam mentioned, it was like a 60% chance of 50 basis point hike in August. I think August the 3rd, is it? Is it August the 3rd?
It is, yeah.
We're now, 60% chance of 0.25%. So it just shows you that, as one swallow doesn't make a summer, but the market's kind of reading it as it does. I like cable. I like sterling, more importantly, more than cable. I always have, I always will. But I would not be getting long here. And I don't recommend anyone else does either.
Well, I think it just comes back to, as you always like to say, the bigger picture, zoom out. We've come from, if you go back all the way to Truss, it was 103, but kind of 117-ish
exactly
last year to 132 in 6 months. If you are desperate to get long sterling, what you want now is a decent pullback. Yeah. Because then, and then you can get in a good position. I would not be trying to buy hot. I would not be trying to lift offers, put it that way.
No, just to get longer sterling, give me a call. I've got some for you,
mate. But you've been selling them since about 120.
Yeah. Averaging.
You ain't got any left.
Right. Let's get on to the last round of the show. Okay, let's talk earnings and equities. Adam, let's start with you because you, at the moment, are spending most of your day squawking corporate results. We haven't had a huge amount of the S&P report. I think by market cap, it's about 6 or 7% so far. So we are still very much in the early stages of earnings season so far. But by and large, results are beating expectations, though the usual caveat applies that everyone massages the expectations lower and then miraculously comes in and beats them. So I guess the big question is this positive momentum. One is how big of a pinch of salt do we take it with? And two, do we think it can continue into some of the big tech earnings next week and into the first week of August as well?
I mean, like you said, they can always massage numbers and beat them, and no sector's better than that than the banks, of course. So, bank earnings being strong at the start of earnings season isn't necessarily too much of a surprise. Yes, some of the macro commentary has been relatively upbeat, but if you kind of want to take earnings season as a whole and you look at the S&P 500, then, as we've talked about many times, the S&P 500 is dominated by these big tech companies, and they very much kind of dance to their own tune. We know that the Magnificent Seven, am I allowed to use that? Is that a bit too,
Well, you can actually, because I've used that a few times. So
okay, cool.
Didn't we do points off last time someone used that? Just flagging.
Well, he's already had a points off, so I'm feeling generous.
So, and just to recap, for those, watching who aren't aware what on earth we're on about here. So that's Apple, Microsoft, Amazon.
They think that all the time, mate.
Nvidia.
I listen to talking to you.
Sorry.
Nvidia, Tesla, Alphabet, and Meta. So they count for around about 28% of the S&P 500. So kind of what these companies do will likely kind of be the main takeaway. And if you kind of, want a bullish view on them, then I think at this stage you need to buy quite hard into the AI story, which, we saw that Microsoft and Meta deal yesterday. It didn't look like groundbreaking news, but then it still added on, a few $100 billion worth of market cap. So it shows from a sentiment perspective, I think, that the market is still really willing to, if they're given anything AI related, they're more than happy to buy up at the moment. And I think that's going to be very important for the upcoming earnings season. Because if you look at the Q1 earnings, yes, AI was part of it. But as we've kind of mentioned before, there was also like the margin actions that they've taken. So we saw the mass layoffs in the tech sector, which helped protect margins. That's not going to be repeated again. And then we also saw some of the, favorable positioning adjustments, going back to last August and heading through the year. A lot of portfolio managers were underweight tech stocks. that's now been reallocated. And we saw, was the Bank of America Funds Manager survey early in the week, tech's now the most crowded trade. So, you kind of need to think about how much more in the way of legs has that got. And I think that'll be kind of the main takeaway from earnings. I think in terms of broader, take, when looking at these earnings as well, I think, we're seeing it quite a lot now. We're seeing these like rotation trades pop up throughout the day, whereby people are selling the larger tech names and they're buying some small cap names. And that's kind of predicated on part of the underlying strength of the US economy, or the real economy as they call it. And the thing you need to bear in mind is, from a market capitalized index, is if you're selling the big boys and buying the smaller ones, then you could be in a world where good news is actually kind of negative for the tape. And at that point, you kind of want to be looking at, well, what's the equal weighted S&P doing relative to the market cap weighted S&P? What's the Russell 2000 doing relative to the NASDAQ? I think that's, in terms of people actually looking to translate what's going on in the market to kind of actionable stuff and being able to kind of express themselves, these are the things that people need to be asking themselves. And there's also one other, in terms of broader macro themes as well, is the price action on Monday was very interesting for people who kind of want to take, aren't so much interested in stock specifics, but, interested in broader macro. I think if some from Interactive Brokers highlighted this, that in the wake of the weak Chinese GDP data, well, Europe was down, US was up. So Europe's obviously had a very good run this year already and is more economically exposed to China. So are we now going to see a thing whereby if China continues to start, stimulus is a little bit underwhelming, do people start selling Europe and buying US? That's kind of, for people who take a more broader macro view, that's kind of one way to potentially frame it.
Yeah, it's an interesting one, that last point. And also, of course, you've got a currency impact as well, because you've seen euro dollar rally 5-6 big figures over the last couple of months. If you think about, again, how much of the Eurozone is, effectively dependent on the export of luxury goods, stronger currency is not going to help that too much. Ryan, the S&P trades 45.94, as near as makes no difference, 4,600. Are you bullish through the summer, or do you think that we are, again, a little bit like cable, that elastic band's gone a bit too far, too fast?
But first off, I would just like to give a round of applause to my dear friend Adam, because that was a hell of an answer. I learned a hell of a lot. I thought that was the best one yet.
I thought I was going to get a dig then for I don't know, just something weird.
I genuinely, because sometimes I genuinely kind of doze off sometimes when you're speaking, but this time I thought it was really, really good.
Okay, well there we go.
Sorry, I can't just give you compliments. You know that. I need
as close as I'll get. I'll try again next time.
No, but genuinely, all jokes aside, I thought that was a phenomenal response, and I thought you covered everything, and I genuinely learned few things myself. That's why I was hoping that Michael wouldn't come to me next, because all I've got is buy equities. There you go.
Well, that could be a better answer. You'd have to listen to my waffle and you get the direction right.
Well, there you go.
I
still like equities higher. I think path of least resistance is higher. I think there's still a surprising amount of cash on the sidelines that it's getting increasingly nervous that they've made the wrong decision and they will have to put in. There's not really any much I can add to Adam's, because I genuinely thought it was a fantastic answer.
No, it was a very good answer. Just one question I do want to ask before we move on to Dick. You mentioned cash on the sidelines. And, I understand, obviously, if you're a portfolio manager, that is going to be making you nervous if you're not in the equity market at this point. But considering you can get, 5-ish, 6-ish.
Right. So this is the thing. So look, having cash and guaranteeing yourself 5-6% or whatever, for your fund is great. However, if you're a fund, chances are, and you have equities in your fund, you're part of your portfolio, chances are you're benchmarking against the S&P. So it doesn't matter that you're guaranteed 5%. Your clients, the people giving you money, they look around and see the S&P closes at 2003, does 20% on the year or something stupid or whatever. They're going to be, why the hell have we only banked 5%? Good luck to you if your answer is, well, it was a guaranteed 5%, because they're not giving you money, because they'll just turn around and say, well, fuck it then, I'll pull my money and I'll invest myself in bonds, because it's very easy to do. Yeah,
especially when they're taking a 2% management fee for that 5% as well.
Also, kind of just to add. So obviously the Nasdaq benchmarking comes up, right? Nasdaq reweighting is coming up. There's a lot of people saying it's really important, including me. I kind of got sucked into thinking it was a bit more important than what it was. I read a Goldman's piece and made a very good point that basically out of all the big kind of named funds with decent AUM, no one benchmarks against the Nasdaq. Yeah. So there'll be none of that index flow related to that rebalancing of the Nasdaq. So
yes,
if anyone is reading, sorry, go on.
No, I was going to say that is a really important point because there was a lot of excitement about that towards the tail end of last week around, it means everyone's going to have to sell half their holdings.
It does. If they were doing it in the S&P, different story.
Yeah. I think that thing almost got psychological because people found out that Tesla was just above the 5% threshold, Meta was below it. And then they started, people who didn't necessarily need to even be on that started actioning it. And there's also a narrative of you're selling Musk, buying Mark, and obviously they're going to have a cage fight in the Colosseum or whatever it is. It kind of picked up a little bit more steam than it should have done.
I suppose, especially with the Twitter threads thing as well, it's kind of got you.
Yeah.
Oh, look, give him another point. Might as well.
He's got enough. Right, Dick, let's wrap up the show with you. As I said, the S&P trading, 4,600. There's even signs that some of the biggest bears in the market this year are starting to capitulate. So Marco, our good friend over at JP Morgan, is now starting to say that there might be some value in small and mid caps in the US. He's talking about a potentially wider path to a soft landing. So are you getting a little bit more bullish, or are you not really buying into what we're saying?
First off, I thought that I've got hats off to Adam. If I had a hat on, I'd take it off. That was a fantastic answer. And actually, I was educated as well.
How much has he paid you for all these?
Honestly, genuinely, it was brilliant.
But very little to add, actually. I know how can I think of what to say? I know JPM have actually turned quite bullish. They're looking for the S&P to hit 5,000 by the end of the year, or a 40% of chance of it hitting 5,000 by the end of the year. I think that whatever the results are, the market's going to be bullish. I think there is cash waiting to go in. I still don't like the stock market. I can't understand why it's so strong. And I think sooner or later that it will going to come up. And what causes that, I don't know. Notice Goldman's figures today were pretty dismal, or very dismal. I'm sure that's caused a lot of people to cry over their lunch. And whether there's a nasty surprise coming out elsewhere, that's what worries me. There's something that we haven't seen the end of the problems with the smaller banks or second-tier banks in the States or indeed elsewhere. So that's the one thing I've been watching out for, just something completely out of the blue upsetting the markets. But apart from that, I think it's really, really hard to go short. I don't think there's any, as Ryan said, you get no awards for missing the market, no rewards for getting 5%. It's just still, I think that you've got to buy. I personally wouldn't, but I think the market wants to be long and it's going to stay long. So take your shoes off, put your feet up, sit on the beach, and have a nice summer.
Oh, the dream.
Well, there we go. What a brilliant note on which to end the show, Mr. Matthews.
Make sure you have a good swim as well.
Oh, of course. Adam Linton, congratulations. You've had 3 weeks away from the show and you've come back and wiped the floor with everyone. Well done, mate. He's speechless. I was going to say, the most remarkable thing here is, Ryan's bought me a few pints, Dick's bought me lunch, you haven't bought me anything, and you've still managed to win. So if there's any accusations of bribery, they can be put to bed.
That's why we couldn't win. That's why we're not up there, Ryan. It's fixed against us.
Like I said, I've done my bribery and corruption training now, so there's no fooling me. In any case, let's wrap up the show there. Thank you to the guests for joining me. Dick Matthews, Ryan Paisey from PIQ Suite, and Adam Linton from Newsquawk. Thank you also to Kyriakos, our producer, who now has an awful lot of editing to do. We'll be back with another show this time next week. If you've enjoyed the show, drop a like on the video, leave a comment, let us know how you're trading the markets, and we'll see you again in a week's time. Goodbye for now.
See you later.
Cheers.
Yeah.